Welcome to TradeTheMBI.com. This is John. This report is for the 2nd of December, and there's a little bit of the weakness. We talked about this where this orange right here of the DOC caught between the cyan and the red gives us a continuation play. In particular here we had sell signals going across. Well, the DOC began originally way back. I mean, you can see that we've been looking at relative down market for some time, though nothing dramatic from that expectation. So you've seen quite a range all the way from, sub 2100 to, almost 22. So quite a range within that, but it has had a general negative bias. Now, we got some buy signals that came in through periodically as we dipped into oversold and got little buyback signals. Now, in this particular case, we started to get weakness when we broke back right about here is where it was first indicating itself, and then we looked for this particular point where the steel crosses below the cyan, which took place. Let me just go ahead and put a marker there so you can always see that from a daily standpoint. Right about there. And in fact, we still had data that went higher. That was right at 2200. And we pushed up a little bit further into the 22, 10, 11 range, but have been struggling ever since that particular point. And so the ABM value right up here at 2193 became, kind of a critical pivot point. It's relative and relevant to what we're seeing right here. We ended up with right at that same day a buy signal within that itself from the MBI Opus right at the 2198, which is what I would recommend on a turnaround move. More aggressive, I would be at the 2193.50 for a turnaround, because the catfish signal, we haven't seen that one, and here's from the other version of it. We had blind hogs. We've had some very interesting signals come in that we haven't seen in years. Predator hog, blind hogs, rolling hogs, catfish. Very unusual, but that's relative to what we're seeing from some of the sector rotation in that. You'll notice that there's a huge anomaly between, that tells everything. The NASDAQ is just getting pounded, and rightfully so. I mean, what are you going to do when you play the wrong side of the field, and now you're looking at some of these very large internet winners are going to be under scrutiny? And you can see already with the active pre-administration of Trump that obviously there's going to be more business oriented, but I think it's going to be about business and fairness, meaning that some of these I think are likely to face some serious review, which that's always frightening to the market. And when you scare the market, obviously people go down. The likelihood of the stimulus is a very popular thing. You can see it, and this is what happens in a populist movement. The industrials, because that's what you're talking about, industrial production. Is the 1,000 jobs of Carrier significant? Yes, because it's symbolic. And sometimes symbolism actually has more power than actual numbers. I mean, he hasn't even taken office or any of those kinds of things, but it's perception that jobs in America are going to come first. Now that's going to put upward pressure on oil and some of these other things, because obviously increased demand for petro, that kind of energy is going to be needed to ramp up that. Is the financial structure that exists ready for that? No. And this is the risk that is existing. Now you can see from a Dow standpoint, huge with that cyan below red. We're reaching a white level here for the red. I don't even know if we've ever gotten there. And I mean, gosh, I can scroll back for a long time here, and years and years and years, and I don't know that we're going to get. Here was the last time. Let's see, when was this? December of 14. And you can see ended up starting to get more choppy when that happens. And so I think that's what we can look for right here. When you see that as it begins to decay, when we get that DOC spread start, which took place right there, we started to get some increased volatility, which is something that we've been lacking. Now, I would argue not lacking all that much in the sense that this is a volatile move. Yeah, fine, it's in the upside. For some reason, I never really consider upside moves volatile. It's always these kinds of dramatic down moves that are volatile to them. I don't know why, because I think that volatility is just a movement in any direction. I could care less which one. Now, whether you're measuring complacency, that becomes a different issue, and we might see a bit more of complacency if we look at the VIX. Now, that becomes a relative an interesting proposition. If there's complacency, then you might have more of an indication that there's a problem. Now, from a euro standpoint, a little bit of a pop back. Now, I talked to you about this before. 105.4 range right down in here was about where I expected to see support from central banks in that. And what did we dip? Yeah, it was right around there that they've stepped in and have buoyed the situation now. And more rallies here in Florence in the heart of Renzi territory against his propositions, and they were pretty decent size. Was out last night with the girls and clearly saw them. So that's an interesting dynamic because, again, this is that populist movement around the world from France on down, and that is just going to put more pressure on Europe. So there might be some excitement that that's going to win, but on the ground here, it doesn't look that great. Now we can lower the bond turnaround because you can see we've continued to dip, and so we can start moving towards that EBM value. A little bit lower, way too high with steel to generate a turnaround on this, and still minus 35. Don't even want to be thinking about bonds. Now look, you had this nice giant pop in oil in the sense that I don't think it's sustainable. We can clearly see that it's not sustainable given the red positive extremes. Those are going to get retraced. The issue becomes you still have so much freaking oil all over the place. They don't know where to put it, and even if they cut back production, it's going to take months to try and alleviate that, and that assumes that in those months you're not going to have a ramp up of shale. It just, the dynamics have been changed completely. Technology does this, and for those who didn't know it, I mean, here in Europe we've been using they have those kiosks at the fast food restaurants. We went as a celebratory thing to a McDonald's for the first time in a couple of years, and they had just installed these kiosks that you don't need an individual to man, and you place the order and it goes directly to the back. And so it also delivers to zones in the room. It's amazing stuff, but it's going to represent a dramatically changing climate for workers. So that's going to be an interesting factor as far as productivity rising, but still maintaining sluggish employment. So we'll see how that works out. Gold is still going to be under pressure. Look at that. It's the same as bonds at this particular point. I mean, there is just a beautiful continuation move spelled out cleanly. Here was the 5K. So started out with the short. We had like zero. We had one little teeny attempted test of the short algo here, and then boom, that was the end of it. And then right as we were ending the session, a little bit of short covering, but even in that short covering, way overbought, and it just cascaded down again. Trying to do a reset again, not quite there yet. So that's the current state. Hopefully I didn't go too long for you, but it's important to understand some of these relative dynamics and how they play with what we're looking at and expecting in our intraday charts, as well as the broader daily. The bias is still decent. It's just a little bit softer, and that's just because of the uncertainty, and this is exactly what we talked about. That doesn't mean that I'm directionally biased strong to the short side. I think you have to have a little bit of a bias that way as long as the intraday charts read what they are. But overall, we're still going to be looking at broader end of year higher than shorter, despite what you might be hearing in some quarters, unless something major dynamically changes. But at this particular point, you got nowhere to go with if you're trying to capture yield. And if the market doesn't fall significantly, the people who are behind for the year on return are going to have to start catching up. So there's the long and the short of it. As always, trade well. We'll talk to you later.